The Money Show.
Personal Finance with Warren Ingram.
23 minutes now to 8 the time. Your questions for Warren Ingram this evening. He is, of course, a certified financial planner at Galileo Capital. 011 883 0702 021 446 0567 and voice notes on 072 702 1702. We're talking tonight about how, when you get to the age at which you retire, you can continue to draw an income without actually running out of money. In a way, this is the whole point of personal finance, is to be able to live, and I do mean live, not just survive, and make sure that you're able to actually have enough money. You don't draw the money down. So, Warren, good evening. You retire, you stop getting paid for working, you have savings, and you've got to make that into a monthly income, and it's got to last a long time. How do you sort of start the conversation around this?
It's a strange sort of psychological dynamic for people who go into that position, because the first question I ask is, just tell me practically, like, how will the money go from my savings or my investments into my bank account so I can spend it? And it's kind of a journey that we all go on at some point, where, you know, we've always had incomings from work, however we've worked and however we've generated the income. And we could manage our outgoings that way. But now you get to a point one day where you don't have an incoming and you've only got these outgoings. And for a lot of people, it's very, if not scary, just sort of a puzzle, like a psychological puzzle. And I think maybe the starting point is just to understand how much you can take from your savings, your investments, and still be safe. And, you know, a lot of us will be quite worried about that. You know, we'll get to the age, let's say at 65, and we say, okay, I want to know that I can live a sustainable life, and I've got to find that balance of, not living so cheaply and so frugally that actually, you know, my retirement is really bad and really uncomfortable. And equally, you know, I can't go and live like a king for 10 or 15 years and then have nothing and be dependent on my family or the state. So the starting point, Stephen, would be, you know, look at the value of your investments and then use the magical number of 5%. So you take your calculator and you say, if my retirement savings, I'm going to use an example. So my retirement savings are 6 million rand. What's 5% of 6 million? Because that's what I can draw on an annual basis to be sustainable. And so 5% is going to be 300,000 Rand a year. If you draw that and you invest your money just kind of sensibly in a very balanced way, you know, nothing spectacular in terms of chasing, you know, the latest SpaceX, whatever that's going to be the next one, not worrying about Nvidia, but just a balanced portfolio of cash, bonds, property, shares, you know, in South Africa and overseas, the likelihood is that 5% will be sustainable for your lifetime. 30 or 40 years, you'll be able to live a quality life. But if you start at 10%, so on 6 million, you draw 600,000 a year, you just need to realize on day one that you're probably going to run out of money in somewhere around 12 to 17 years. My view is around about 15 years. And I think that's maybe the point where a lot of people go wrong, is right at the beginning. They either draw far too little because they're so desperately worried about running out of money, or they draw far too much because they go, this is what I need. I can't live on less than whatever the number is. But if you start that way, there's no way to recover. So if you're drawing far too much on day one, it's impossible for an investment to grow at 10 or 12% a year for 40 years. There is nothing that does that. You could be lucky and get that. But if you start at 10%, you have to make up all of that plus inflation, and you're just not going to come right. So I think that starting point is the magical number of 5%.
And that's a year. So you need to divide that by 12 to work out what you're going to be living on every month, basically. To put it another way, what your new salary is.
Yeah. And so you look at that and you say, well, that 300,000 a year, that's going to be around about 25,000 a month before tax. And the one difference between our normal salary from work and our income from our investments is we have a little bit of capacity to do some, good and certainly legal tax planning, because you can allow some of that money to be capital growth. So when we pay tax on our savings and our investments, generally we're going to either pay tax on the interest, or if we've got rental income, we're going to pay income tax on those two, or we're going to pay capital gains tax. And for a lot of people, when you've got an investment asset, an investment portfolio, you might find that actually you end up paying a bit more capital gains tax. So your 25,000 a month, you're not paying away 45% of that to SARS. You're going to pay away a lot less. So tax planning becomes a bit better, and equally that the tax boffins will also tell us in the messages that when you turn 65, you start to get a lot more tax benefits from SARS as you get older. You get a few more tax breaks, and those improve at 70 and 75 as well. So I think that 5% number is really key in this whole thing.
Okay, so do you stay at 5% the rest of your life, or do you? And I just want to get this right in my head. So your money is still growing, right? So the 5% is basically to keeps up with inflation and your investment. So the money that you have, let me put this another way. You retire. You have, the example you used was 6 million rand. The 6 million rand is still growing because it's still invested. It's not sitting in your bank account. It's still growing because it's invested, right?
Exactly right. And I should explain how and why that 5% works. So you take your 6 million, you invest it in a good balanced portfolio. It's likely that over a decade or 3 or 4, so let's say 40 years, realistically, if we retire at 65, most of us won't make it to 105, but we wouldn't mind planning that just so we're safe. We run out of life before we run out of money. And so in that instance, you would expect a balanced portfolio to give you round about 10 or 11% growth a year. And if that's happening and you're drawing 5% a year, it means you're leaving behind 5 or 6% a year growth to compensate for the cost of living. Our big concern here is that you want to make sure that the buying power of your money is consistent over time. So if you're drawing 5 and the cost of living is going up by 5, then your growth rate of 10% is exactly right. And so certainly at the early stages of retirement in the first decade or two, I think you would do well to keep drawing 5%. And understanding that, when you start at 6 million, but your capital is growing, it doesn't mean that you're only ever drawing 300,000 Rand a year. Next year, you'll be drawing a higher amount because your capital has grown. And so in most of the years when we get good growth, you might actually be able to draw a slightly higher Rand amount because the percentage goes up. But, and to your question, there will be times when, unfortunately, the markets go down, your investments go down a bit, and your 5% might be a little bit less than it was the year before. That's the downside of living on your investments. But when you get to age 80, 85, by all means, you can start to increase the percentage that you draw. You can start to go up to 6, 7, or even 8% as you get older. And I mean the maths is simple, but the reality is then that you're not really planning to live for another 40 years if you're 85. And so it means that you can start to draw a bit more, because the likelihood is that if you're eating into your capital a little bit as you get older, you're not going to run out of money before you pass away.
You also suggest that you should keep a cash buffer. Now, what's the cash buffer for?
So this is, we've spoken on the show a lot about emergency funds, and this is a little bit different to an emergency fund. So for a lot of people, if someone was retiring, right now, and they were retiring on the 1st of September, they might be rather worried when they look at the state of global markets that things have been going pretty well all around the world, and there's an enormous amount of fear, but stock markets have done fairly well, and there's I guess a rational concern that maybe markets might fall over and drop 20 or 30% somewhere along the line in the next year or two, and if it's your first year of retirement and your investments, you're starting with 6 million. And suddenly, the markets lose 20%. That has a really big impact on your the rest of your retirement. So the propeller heads call this sequence of risk returns. But let's not get stuck in the jargon. What it really means is if you're drawing from your investments, at the start and the very first few months that you're drawing, the markets are going down, it has quite a big impact on your financial future. And so the way you can protect yourself against that is to start with quite a nice big cash buffer inside your portfolio of investments. And for me, you could look at around 6 to 12 months worth of your expenses. And it's not, you're not investing in something amazing that's going to give you a great return. You're going to choose something like a money market fund. And when you start your retirement career and you start drawing from your investments, if the markets are going well, the portfolio is doing okay, then you leave your cash buffer alone and you keep drawing your 5% from your investment portfolio. However, if you start on the 1st of September, to go back to the example, and early November, the markets fall over and global markets lose 40%, then you don't need to keep drawing from your investments. You can go to your cash buffer and start to draw some or potentially even all of your income. If you've got 12 months worth of expenses, you can start to draw an income from that buffer for, let's say, 6 months. And if you draw from that for 6 months, the likelihood is that the worst of the market crash will be done somewhere around that 6-month period. And you can start to rebalance the way that you draw. So that cash buffer is really powerful for people who are worried about the big market moves. And if things go well when you start your retirement and the markets go up for the first decade and nothing goes wrong, keeping that cash buffer is a very nice psychological kind of safety net. And then if the markets take a hiding, you've always got that powder dry to deploy when you need it.
Okay, I've got some other questions to ask about this. It's very interesting. We do have a question though, saying, "Hi, I'm 36. I run my own small business. I don't have any benefits through an employer. I'm the only income earner in the house, and I have 2 young children." So you can imagine what this person is thinking and about what they're actually thinking about and how they're looking at trying to manage it. But then they go on to say, "I have life cover in case I die, but a friend mentioned I should also have something called income protection or disability cover. I don't really understand the difference, and money is tight. So I'm not sure, is it worth it?" It's from Safiso. Do you need income protection or disability cover, and what's the best way to do it? How do you look at Safiso's question, Warren? Because I think income protection is really important, but it's not cheap.
It's not cheap, and ticking the first box of having life cover is a very good call, and why a lot of people are happy to do that is because if you're young and healthy, then life cover is relatively cheap. But unfortunately, disability cover is usually quite a bit more expensive, and especially for someone in Safiso's position where they're on their own in their own company, and so I think the short answer is I understand money's tight, so that's the tricky part. But is it worth it? Yes, it is. The thing about being 36 years old is your company might be an asset for you, but your other biggest asset is the next 20 to 30 years of your working life where you have an ability to generate an income. So ensuring your first or second biggest asset makes a huge amount of financial sense. And so I would say, yes, you should do that. And get a few quotes to find out, what it would cost. The difference between disability and income protection. Income protection will pay you a monthly amount, hopefully going up with inflation for the rest of your working life. If you are disabled, let's say it happens at age 40, then to the age of 65, you would get a kind of the equivalent of a salary. Whereas disability is usually a lump sum, and they'll pay out a lump sum to you, and then you decide how that money is deployed to look after yourself. And they can be expensive, but I think it's a huge risk that you should be insuring against to protect yourself. You are the only breadwinner, and it's your own business. It's worth doing.
Okay. Yeah, I know, very wise. Safiso, you're going to have to consider that. Kanisa in Randfontein has a question. So, Kanisa asks, "Stephen, please ask Warren, when did it change from the 4% rule to 5%? Was it the 4% rule that you could spend 5% a year?"
The 4% rules magic, and the reason that they're different is 4% generally applies more to people who live overseas. It's kind of a US rule. And in South Africa, we've tended to have slightly higher returns above inflation. So retirees here can start with a slightly higher drawdown. But in an ideal world, if you are able to start at 4% at age 65, I think it's a good call. You do get that safety. But if you start at 5% at age 65, you should still be okay.
Okay, and then Gary, I don't know if you can help Gary here. Warren, I'm a pensioner. I'm 65 years old. I bought a lot of SPAR shares, and SPAR's had such a rough time, and they've already lost 30%. I'm starting to panic, and I'm having too many whiskies. What should I do? Sell or hold on? I mean, this is really a question about SPAR, but it's a reminder, Gary, of Warren, excuse me, of what happens if you put too many eggs in one basket.
I've got a few strong pointers for Gary. Number one, stop the whiskies and save your money. It'll help you be clear thinking when these things come around. Number two, once you're in a specific share and it's going down like it has, it will pay you to understand the future prospects of a share like that. So it doesn't really matter what you paid and what it's worth today, because the deal is what's going to happen into the future. So if you do your homework and you realize that SPAR's not going to recover, if you believe that the other competitors in South Africa are doing a better job, better management teams, more realistic chance of growing, then your situation is that you probably need to sell SPAR and deploy the money elsewhere. However, if you think that you understand why the share's gone down and you think there's a turnaround and you think that it will do better than its peers, then you should hold on. Which of those two is true, I have no idea. I think it's a bit of a coin toss if you were to ask me. And then maybe the other comment is, if you are going to sell, take the money and spread it across a proper spread of shares. Don't allocate a large chunk of money to one share. You're going to end up in this story again and again, unfortunately.
Okay, we've got just 2 minutes left. You mustn't put everything into cash, right? It might be tempting, but it's a bad idea.
Yeah, so we're living, in, as I was saying at the start, really volatile times now. And, the temptation to say, well, let me just earn an interest rate while everything settles down. It's such a psychologically attractive idea. The problem is that, things might not settle down for 4 or 5 years, and markets could boom in that time, even though everything is rocky and scary. And your biggest enemy when you start your retirement career is not volatility of markets. It's the cost of living that goes up every single day of every single week of every single month of every single year. And you have to protect against that. And unfortunately, putting all your money in cash only guarantees that you will not be able to do that. So the certainty of cash is so expensive that you're going to have to embrace the idea of spreading your assets across the stock markets, the bond markets, property markets, and then some cash.
And then the idea of a living annuity. So how do you do that? I mean, how do you match the product to the person?
So most of us, when we retire and we take our retirement funds, whether they're company retirement funds or retirement annuities, we legally retire those. So we retire ourselves and we retire our retirement funds, and we can put the money into a living annuity, which means we own the asset and we decide the amount that we want to withdraw. The law allows you to withdraw somewhere between 2.5% to a maximum of 17.5% from your living annuities when you retire. We've just discussed that you really shouldn't do 17.5%. That's a really bad idea if you're starting out your retirement. And equally, that you might want to stick to that somewhere around that 4, 5, 6%. Don't go over. If you're really desperately worried about markets and you think that the world's going to kind of end again and again and again, and you don't have the emotional fortitude to deal with markets going up and down, which is going to affect you in a living annuity, then you could exchange your retirement lump sum for something called a life annuity or guaranteed annuity. And that's when you basically give all your retirement funds to an insurance company, and in exchange, they give you a guaranteed income for life. hopefully they allow that income to escalate with the cost of living. The big trade-off there is nothing left. When you die, the money's gone, but in your living annuity, when you die, the money that's left over goes to your beneficiaries.
Warren Ingram, thank you very much indeed, the co-founder of Galileo Capital in personal finance tonight.